Hi, my name is Darren Joseph from HTJ.tax. We're the team that seeks to demystify this sometimes confusing world of international tax, and the privilege of having a deep conversation with Mark. Mark, can you please introduce yourself?
I'm Mark Morris. I'm based in Switzerland. I've been here for about 26 years. I've specialized in automatic exchange of information, which originally was the EU Commission's EU Savings Tax Directive. And that went on until about 2014, and they scrapped that and they adopted the OECD's FATCA made into CRS.
So can you share with us what it is you do professionally?
Primarily, I provide custodial services for trusts to hold underlying entities or partnerships or unincorporated funds. So what I do is I provide the administration services for the custodial. I don't do the actual custody. And later on, I'll explain what administration services for custodial is. And I'm an expert in CRS and CARF, and I certainly know the intricate differences between CARF and CRS. We'll get into that in a later question, okay? I've published over 600 articles on LinkedIn, and I'm still writing about 10 a week. And I don't see other people covering 99% of the topics on CRS that I cover.
Okay, thank you. What do you think about the common reporting standard, the automatic exchange of information?
Well, the CRS has reduced the amount of offshore deposits by 1/3. So it still means 2/3 is still banked offshore. And I always got a query, why does somebody have an expensive company to maintain in the BVI or Bermuda, etc.? There's no statistics of how successful it is, but I think the only statistics that's useful is how much offshore deposits fell. And if it only fell 1/3, I got a query. I mean, the OECD is going on, we collected 28 billion, but there's no stats of how much loopholes there are, etc. And there are quite a few loopholes. That's what I write about.
Okay, so let's say one of the two biggest loopholes that you'd find with the CRS framework.
I would say the two biggest ones, there are probably a dozen, but the two biggest ones would be this shell bank loophole, this investment entity, you report nothing. The other, which might even be bigger, is they never included what they call active non-financial entities. So active is more than half the income doesn't come from passive investments. It's not interest, it's not dividends, not capital gain. So people hold cash, okay? So you're not earning much interest. 50% cash, 50% is investment, okay? And then say you've got a company, active NFA, you can just invoice some consulting fees or rental income or intellectual property, or there's just so many commissions, for instance. If you're a broker and you're earning commissions offshore, that entity is called an active NFA. And active NFAs were generally in the beginning aimed at large companies like chip manufacturers or restaurants. And they said, we don't want to overload the system with all these active companies. But to me, an active entity with an offshore company is fishy. And second of all, let's say Greek shippers, they just embed their investments in the Greek shipping company. So active NFAs is, to me, probably the biggest loophole, because it's easy to certify to the bank, I'm active, and more than half my income comes from income that's not from passive income, not investment income.
So you have the passive NFIs under the active NFI.
Yeah, but as long as the active meets the 50% threshold. And no, in May, the OECD came out with an update to the OECD frequently asked questions. And it was always ambiguous whether cash, money, is a financial asset. To me, it's the ultimate financial asset, right? But they actually said cash, money is not a financial asset. So that means if you're holding cash, money, that's not a financial asset. So the way that banks help people avoid FATCA, because FATCA only reports one thing, reciprocal, that's interest earned on deposit. And then if there's a report that you earned interest, then there might be a question, what else does he own? So the banks in America very often offer non-interest earning deposits so that there's no reporting whatsoever. And then there's no question to ask. Exchange on demand is a part of automatic exchange, is automatic exchange and exchange upon request or exchange upon demand. And exchange upon demand is if you get a hint that this guy's got an account, you can start asking more questions. That's why the exchange on demand on the trust, which you mentioned early on, well, there's no exchange on demand because you don't know that client is from your jurisdiction. So you can't ask.
Gotcha.